We are live with Ben Rabidoux and my little brother, Nicholas Alexander Karadza. Ben, did I say your last name properly finally or no?
Yeah, you nailed it. Yeah, that was perfect.
Finally. Third time's a charm. Maybe it's the 20th time. But listen, before we get into like very important real estate stuff, and you brought up Bitcoin, I didn't bring it up, Nick, for the record. He brought it up. I do want to get his comments on that. But Ben, what's the deal? Your buddy doesn't go fishing with you. You catch a big fish. You post the picture of you with this massive fish. I don't even know what type it is. I'm not a fisherman. And you basically take a jab at your buddy saying, hey man, it's a beautiful day on the lake. I guess you're on some lake somewhere. Where are you? What's the story? You fish and you fish with your buddies, but they don't show up.
Yeah. So the story was heading down to Lake St. Clair, which is a famous muskie fishery. And so in the fall, we always get down there, try to get down a couple of weekends, and tried to get one buddy to come down on Friday and take the day off. He couldn't swing it. And so I was down there fishing by myself before they could come on Saturday, and got a decent muskie. And then, so yeah, I just took a bit of a trolling video, just kind of, just starting off with me in the frame saying, hey man, really sorry you couldn't be here. It turned out to be a beautiful day. And then I kind of stood there and then went, well, I better get this big girl. And I pulled this big fish up. I'm going to get her back in the water and dumped it back in. And muskie,
for my friends who do fish, muskie is the catch, right? Like muskies don't want to be caught. You can't catch them. If you catch them, you're like a hero to all fishermen. That's the way I need to understand this, correct?
Yeah, that's right. They're kind of known as the fish of 10,000 casts. They're pretty elusive, big, top predators. Lake St. Clair is the top muskie fishery in the world by a wide margin. So it's about the only place you can go and like consistently know that if you go out and spend, a solid day, you have a very good chance that you're going to get a muskie. It's the only fishery that's kind of like that in the world.
Cool. And this has been something that's been in your blood for some time?
Yeah, I mean, I've been fishing forever. I mean, it's kind of a passion of mine. So yeah, muskie are just a different. The muskie fishing's fairly new to me. So it's like anything else. There's a learning curve to it. But yeah, we generally.
I don't know how you do. I don't know. Yeah, it's relaxing to you. When my buddies have taken me fishing, this is a true story. Like I brought a book, and as they were fishing, I sat in the boat and read. That's how sad. That's I know. Like Nick, Ben's literally loud. He doesn't even know what to make of that comment. And then I went swimming, and they were pissed that I went swimming because I like disturbed like the water or whatever they told me. So I was never invited back after that. It was a disgrace. I was a disgrace to them apparently, and to all fishermen worldwide.
Is the muskie? Awesome. Isn't that what Frank is? Is that referred to as the ugly pike as well?
Yeah, probably. Yeah, they're in kind of the same family. Yeah, that's probably right.
Because Frank, the guy we know, has a beer that he launched. And is it, Tom, wasn't it in the LCBO now? You were talking.
It's in some LCBOs. Yeah. I don't know if it's wide yet. The ugly pike.
He called it the ugly pike.
Oh, yeah.
So, yeah.
And for that.
Yeah. And there was a big fishing controversy that he was telling us about, but those competition fishermen, I'm sure Ben knows, that were stuffing the fish.
Stuffing weights, Well, these guys had won $400,000 the prior year. And like these tournaments are big money in the States, right? It's not your recreational, beer league buddies going out for a couple hours to fish. These are is big money, big sponsorship. So these guys had won $400,000 the prior year in this walleye fishing circuit. And then turns out they'd been stuffing lead weights. And
I saw those videos.
Crazy videos. And cutting these fish open, these great big lead balls were coming out. It's just wild.
And some guy was saying they never understood why they were losing because they had fish that looked kind of the same. But at the weigh-in, I guess, to decide who wins, there are these other people who were cheating. They were always had the heavier fish.
Yeah, but exactly. At any rate.
Okay. Yeah. Speaking of wild stuff, we got to get your updates here on, I don't even know where to begin. Today you posted something. I didn't know you can get a guaranteed 25% return on condos. So where
up to 25%, right?
Up to. So, you got to read the fine print. I didn't see that. Yeah. So Ben was having fun with someone who posted that you can make a 25% gain on condos, and it kind of was making it seem like almost like a lock the way the wording was.
Well, they did use the word guaranteed, right? Anytime you see the word guaranteed in any pitch for an investment, it's always like the red flag should be going off in your mind. So
where are we at then? So tell us, I have a bunch of stuff I want to talk to you about. Let's just start with the condo market because I brought that up. What are you seeing in the condo market right now? Is anything surprising you? Whatever you want to share. Why don't we just
let's go 10,000 foot. So broadly, what's happening in real estate in Canada is the impact of rates is still kind of the primary factor that's affecting this market. And so, look, longer term, the population dynamics look just incredible. We had record population growth in Q3 by a massive margin. And on a year-over-year basis, it was 700,000 in Canada. We've never seen anything like that. So you kind of zoom out to the longer term, and there's still some very positive underlying fundamentals. That really won't matter in the next little while just because of how severe the affordability issue has become. We've gone from mortgage rates that at a low, you get a variable at under 1%, right? And today you're 5.25%. That's a massive impact. And so what I look at is, okay, what does that mean for your monthly mortgage payment? If you bought like a typically priced home, and you kind of run the calculations every month. And if I bought it this month and financed at 80% loan to value at the prevailing rates, what's my mortgage payment? And that chart looks like a hockey stick. It was basically flat from kind of 2016 to 2021, and then it's gone kind of parabolic. And so today your mortgage payment to buy a typically priced home is about 50% higher than it was a year ago. And so we could talk about all those other positive underlying fundamentals. It's just not going to matter in the next year or however long it takes till we get some resolution to the affordability issue. And so that's kind of the primary driver of the market. Now, what's interesting is, so we know that sales are low. Okay. And in Ontario, they're almost like, I think they've almost certainly hit pretty close to a trough because we're at basically 1990s level of demand.
Because they can't go lower? Yeah.
Yeah.
Because they just can't go lower.
Yeah, no, that's it. Like eventually there's a floor. Like you do have population growth. People have to live somewhere. They're either going to buy or they're going to rent. And you just can't, it's really not reasonable to expect that demand's going to fall much further from here. I think we're probably at more or less the lowest for demand. But what's interesting is that we're just still not seeing a huge influx of supply. In fact, if you look at new listings coming to the market in a place like Toronto, it was the lowest level of new listings in a decade last month. And so, that's going to be the big question in my mind is what happens come the spring? Because I don't know yet whether demand is going to rebound first or whether we're going to start to see more supply coming online from people who are either refinancing at higher rates and realizing they can't afford it, or thought they were going to close on a pre-construction condo and own it as a rental and realize that they can't close and have to assign it or close and flip it. Like there's a lot of dynamics at play that I think are going to introduce some supply to the market next spring. And the question is, okay, well, are we going to have the supply rebound quicker than demand, or whether we're going to start to see maybe demand come back to the market, especially if we get some stability around rates? So that's kind of the big thing I'm looking at is like, I think this market inflects one way or the other next spring. My bias is to think that it's probably going to be like, I think prices are going to grind more or less sideways till the spring. And then, if we get a big supply response, maybe there's another bit of a leg lower, but there's just so much clouding the outlook at this point.
I remember we work with investors predominantly outside of Toronto proper. So like kind of Golden Horseshoe, we don't see any outright panic yet around the fringes of some investors. We are starting to see, I might want to sell a property. I could use some liquid cash. Let's maybe list that, get ready to list it in a month. So we're with you exactly that like around mid-February, mid-March, we should get a feel from our client base anyway. Are we seeing just like, holy shit, we need to list some properties, sell these at whatever price that we need to sell them? Or are we more at like, it's just going to, the standoff kind of continues and we get some supply, but no one's really kind of changing on their price expectations too much. So yeah, you're right.
Yeah, I think that's a fair point. The one thing that I worry about is that like the one dynamic we're seeing that has not been there in other, call them like mini cycles, whether that's even 2009, but 2015, 2017, 2020, where you had these kind of short, shallow downturns, is there was never really an element of like forced selling. Right. The economy was still strong at those times. Rates were still relatively low so people could carry it. And no one was forced to sell at renewal. And the one thing that's concerning that I'm seeing right now is like, liquidity in the private market is definitely tightening. And so you're starting to hear the first signs of non-renewals in the private space.
Because if you can't get the private money again, you're out of.
You have to sell. You have to sell. And so, you know, you've got that element. And then the other thing is, even if you weren't with the privates, but let's say you were with an institutional non-prime, like, you know, Home Trust or an Equitable, which a lot of investors used, right? Because they had better debt service ratio guidelines, a little more favorable for investors. Well, if you look at that, you know, you're still 1-year mortgages. And so if you took out a mortgage a year ago at 3.5, you're renewing today at like 7.5. And so what that does to your rental economics is pretty awful. And so, you know, I do worry, like that's a dynamic we have not seen, is that element of forced selling. And I think that you're starting to see the early signs of that. And so, you know, who knows how it plays out.
I think for me, it's all that makes sense. And then
Nick, is your mic on? Yeah, sorry. You're just a little, I can hear him too. It just feels a little like through his laptop. Sorry. Go ahead.
Yeah, for me, it's the condo market where I get not necessarily the condo market, pre-construction, and then in Toronto, most pre-construction is the condo market, because I think a lot of these people, I mean, how many real estate investors or people that thought they were investors looked to.
Yeah, you got to use that term loosely a little bit. Yeah.
You know, they're just like, well, I'm going to buy this because it's going to go up and I'm going to sell it and bank $100,000 by the time it closes. And they're not going to be able to close. And I remember I was young, but I do remember, Tom, remember in the Mississauga area, remember around Webb Drive in the early 90s, where they built a bunch of condos in that area, about in the Square One area. And at that time, those condos got decimated, because then when I started investing, I was looking at that area and I was looking at the prices, which was like far beyond when that crash happened, and then we're just catching up. And I know the dynamics, from my understanding, the dynamics of that time is we were much more overbuilt at that time than we are now. We didn't have the same population growth and that type of stuff. But I just think that gets sketchy, especially when you have a building and everyone's got the same unit. And I know, Ben, you share the single family numbers. You know, I just feel like it's two different segments. There's still challenges there for sure, but because of the influx of supply on the condo side, that one looks to me that it might feel a little bit more pain before other sectors.
I totally agree there. So when I think about, what are the hinge points and kind of the big risks in the market? Right now, I'm focused a lot on understanding that kind of non-prime liquidity factor. But then the other big one is pre-construction, because it's clear to me you're going to have distress selling there. We're already seeing it, right? And so just interesting anecdotes here, because there's not great data on the size of the pre-construction market, how many buyers won't be able to close it. We don't really know that until it kind of happens. But I will tell you that in speaking with some real estate lawyers, one of the interesting trends from the last few years is they say that when they would used to review these pre-construction contracts, the typical buyer would be, a couple, and they were going to buy it and they were going to own it and hold it as a rental. Okay, and that was predominantly who they were dealing with. And he said in the last couple of years, it really shifted aggressively into a person who's buying multiple units, and the end game was not buy it, hold it, lease it out, own it long term. It was buy it, assign it. And the point that he made that was very interesting is not only are they intending to assign it, they don't have a choice but to assign it, because if you understand the way that the process works, is before you consign pre-construction, the developers typically want to see that you have gotten some sort of a soft pre-approval to show that you have the borrowing capacity. That's typically a requirement from the lenders on the construction project. They want to know that the buyers can actually close. And so you can go to a bank and you can get this kind of soft pre-approval where they basically check your capacity and make sure that, in theory you can, but it's not a formal, we're guaranteeing that we're going to finance this in most cases.
Yeah. And anything can change, employment can change and all sorts of things can happen too.
Right. But even more importantly, it's not on your credit bureau. You can't pull a credit bureau and realize that this person has contracted on this condo. And so what that means is I can go to this condo and I can show that I have the capacity to close on that one. But then I go to the next one and they don't realize that I've contracted to close on another one prior. And so I might be able to close on that one, but I can't close on the second and the third and the fourth, right? And there's no way for the developer to see that, right? And so there's definitely going to be forced selling there. There's no question. We're already starting to hear from some of the kind of big pre-construction realtors that they're seeing pricing that's kind of like barely above 2018, 2019 prices for some of these sort of distressed assignments. I think we're just getting started on that. And the big issue is if you think about, well, who's the typical buyer of new condos in Toronto, it skews heavily to investors in recent years, right? And no one in the industry denies that. The estimates vary, but call it half of new condos are typically going to enter the long-term rental pool at completion, which tells you that it's about half investors. But when you look at the condo rent cash flow dynamics right now, and I track this monthly, you guys have seen the chart. It's like, if you bought a condo in 2018 and you'd rented it at prevailing rates or prevailing rental rates and financed it at prevailing mortgage rates, your cash flow was X. And it was generally a little bit positive. And then you got some principal repayment that kind of added some juice to it, right? And you roll that forward to 2022, and it's like it's deeply negative, like $1,200 a month on the headline. And even once you add back your principal repayment, you're still negative. So there's nothing to be gained from a pure cash flow perspective from buying a condo today. And so who's stepping in to buy this stuff at these prices? That's what I don't get.
I think right now the answer is no one, based on the new unit sales month over month, and I think I've seen it probably your reports and elsewhere. It's no one stepping in. And we're seeing a lot of investors too. They're like, hey, look, I'm still interested in the sector. The properties I have, I'm happy, and I'm interested in this stuff. But maybe I'm just going to wait. Let me put my hands in my pocket. Just even with new home buyers, there, some people that were shopping for properties, they're just like, let me just see, let this all settle. And then I'm going to see things in a few months. So that's why I think there might be, maybe not if there's an influx of properties, but how we're talking about inventory on the market coming in the spring. That's why it's interesting to see. I guess it'll depend on what the carrying costs are and where prices are at, because with a lot of people with their hands in their pockets, does a little bit more demand start creeping out in the spring as well as some of this supply comes on? I would imagine it would, but I guess I just don't know how much and if it's enough and what the inventory will be and that type of stuff.
It's also the most dangerous. Right. Oh, sorry. Go ahead, man.
I was just going to say, it's clear to me that there are people who are waiting on the sidelines, waiting for some sort of clarity around how high rates are going to go. Mm-hmm. And so, you don't even need interest rates to fall necessarily, but I do think if the Bank of Canada gives some sort of signal that, okay, this is where we're going to stop, right? Yeah. That alone, I think, is going to bring some demand back to the market. Now, again, I don't think it's going to, we're not ripping back to 2021, early 22 levels, but but I do think the lows are probably in for, they pretty much have to be when you're at 1990s level of demand in Ontario. Right.
It does hurt. Sorry, go ahead, Tom.
No, go ahead, Nick.
I was just going to say that where rates are to go up this far, this fast. I mean, everyone knew there was some rates, there were going to be some rate moves. I didn't think they would be this far. I thought the system would start breaking actually once the September one hit. I'm like, I don't know. I think things are getting squirrely in financial markets now. I think things are going to start breaking at this point. And it kind of did in the UK a little bit. I'm like, oh, is this the first kind of shoe to drop? Yeah. But then they've kept going since. So, I mean, I didn't think
that's an interesting point though. That's an interesting point because of what has happened with the carrying cost of money so high and the cost of money so high. I wonder if we get hit with an economic kind of curveball that none of us kind of can forecast right now that ends up changing some of the Bank of Canada's policies. That'll just be interesting. I mean, it's just a wild guess, but I also wonder how long the Bank of Canada can pretend to be independent from the commercial banking system here in Canada, because banks don't want to take properties back on their books. Look at the financial crisis in the US in 2008, 2009. Ben, we know people that were doing something that they would call strategic defaults in the US. And it was just a name that kind of took a life of its own, but they just stopped paying their mortgages because they knew the banks weren't going to foreclose for 2-3 years. Sometimes they stopped paying their mortgages for 2 or 3 years. The banks were so overrun with properties, they lived quote unquote free.
Oh, I see what you mean. Yeah. So
it was not an official. It was not an official. Yeah. It's basically some people just figured out that the banks were overrun. And they said, these guys can't even foreclose on us. It's taking them 2 or 3 years. We're just going to stop making our mortgage payments.
Yeah.
And I guess that got to be just terrifying for banks to hear. And I don't think we're anywhere close to what happened in the US there. But I do wonder, how much influence does our commercial banking sector have over the Bank of Canada? Because if they start to see things wobble, I just have this weird gut feeling that they're going to scream bloody murder to the Bank of Canada and get the Bank of Canada or the government Government changes amortization schedules to say, okay, for first-time home buyers, we need to make housing affordable. It's a campaign issue. First-time home buyers get 40-year amortizations or 50-year amortizations just in this segment because it's the right thing to do. Or the banking sector just tries to influence the Bank of Canada to make some changes to reliquefy the real estate market without dropping rates. Because you can hold rates high and change amortizations. And I'm not saying this is right, by the way. I'm just saying I could see the banking sector kind of push for this.
Yep. Well, first of all, I'd say, it's interesting. We talk about the strategic defaults. I think to some extent we're seeing that already in the rental market here, just because of how backlogged the LTV is, right? You see, some of the horror stories coming out are just brutal. I think that kind of got some momentum during COVID and all the kind of payment holidays. And it kind of feels like that dynamic's happening to some of the small landlords. I'm sure you guys have some horror stories from some of your clients. Look, a couple interesting things as it relates to the Bank of Canada and kind of how they're perceiving risk in the housing market. One of the really important comments from the Bank of Canada came just a couple of weeks ago from Carolyn Rogers, who's like very senior at the Bank of Canada. And she gave this speech, and it was kind of a stunning statement. She basically effectively said, like, house prices are coming down and we want them to come down. And it's sort of the intended outcome of our policies, right? And that was sort of the first time that you heard the central bank say, yeah, we recognize that prices are going down. Good, right? And so they're not going to blink yet, right? They've sort of put themselves in. Now, let's keep in mind, this is the same central bank that said you can be confident and go out and borrow because rates will stay low. So look, things can change quickly. We understand that. But as it stands right now, they're not at all concerned about what they're seeing. I think they view this housing downturn so far as being quite orderly and frankly being a positive thing longer term. Now, look, we debate that, but that's clearly how they're signaling. Now, the other thing on the foreclosure side, look, I think you don't want to overrun the system, but I also think we've kind of gotten used to a level of arrears that is so absurdly low, right? So if you look at the official data, we're still talking about 15 bips of arrears. They can at least double from here just to get back to long-term norms, right? So there's a lot of room in the system to just normalize without even going above that into sort of
that's a good point.
Territory,
yes,
right. Yeah. And so we're nowhere close to distress, right? And this is funny because Nick, you were kind of commenting on this, and I agree with you completely. Like, if you had told me a year ago that we'd be sitting here with 5% mortgage rates, I would have said, like, holy shit, the system's going to blow apart. And for all of the concern, and I understand there's pain for first-time buyers and pain for people refinancing, but the economy still looks pretty good for now. And there's really not a ton of signs of stress. Even credit card delinquencies, they're up off the lows, but they still have to almost double from here. Like if people aren't defaulting on their credit cards, they're not defaulting on anything else, right? Like auto loans are ticking up a little bit. That's kind of it. So we're just not anywhere near the pain point where that will drive Bank of Canada policy.
What do you think then, if you were to forecast a little forward, some of the data out of the US, specifically the ISM data, some of those economic indicators seem to be falling right off a cliff, like literally going straight down at this point. What's your take? Do you think, if the last 10 years were a grind up, property prices, basically since we started this business in 2008, our family's been in real estate since the 1970s. By the way, Ben, our mom rented out properties just off Weston Road in Toronto for $12 a week. It was a boarding house. $12.
Yeah, rented out rooms, not property. Rooms.
Oh, sorry, rooms. Yeah. Rooms for 12. She would change the bed. Is that like a really early Airbnb kind of thing? Or by the way,
guess,
like a home. But what? Anyway, so we've seen kind of a lot of stuff happen, but since 2008, it was just a grind up. The property prices just went up, and then they kind of went up faster. Do the next 10 years, do you forecast them to be, if you just have to take a guess, just volatile? Because I wonder if the last 10 years were just pretty steady up other than 2017 blip. Are the next 10 years possibly just straight up and then kind of activity comes straight down and then it goes straight up again? Are we just in a wild ride for the next 10 years? Because when I see the ISM data coming out of the US, I'm like, holy shit, it looks like their economy is going straight down. Yeah.
It's a really confusing time to be kind of a macro analyst because a lot of nothing is telling a consistent story, right? Mm-hmm. You've got ISM looks deeply recessionary. the OECD's composite leading indicators look deeply recessionary. Yield curve is massively inverted. Like a lot of the kind of warning signs that there's stress down the road are there. But the current data just keeps surprising to the upside. And I understand, like in some cases, you're looking at backwards looking with regards to employment stuff. But like, even look here in Canada, we still have 1 million job vacancies, right? Like it was a stunningly high number last month. You had a better than expected jobs report, unemployment declined, wage growth is accelerating. Like all the things, you had all of these, the small business survey. Still, like share of respondents that are saying that they've got a shortage of labor keeps going up, record highs, right? So like, it's a weird time in macro. And I do still think we're probably looking at a recession. Like I think it's, I'm not going to say it's certain, but it looks pretty likely. Mm-hmm. But the question is what's the nature of the recession, how bad it's going to be. Like it's hard to envision a 2008 style, really nasty recession just because we're still so short labor. So all that said, now you asked the question of like, what does the next 10 years look like? And look, those sort of timeframes are really challenging. What I would say, what I'm struggling with, and what I think is like the big issue potentially is, are we in an environment of structurally higher inflation? Mm-hmm. And so I would point to, okay, we've gone through this last 30 years where you had tremendously deflationary technology. That trend's probably going to continue. But you had massive globalization, taking advantage of cheap labor in other parts of the world. And you also just had like really cheap energy prices. I know it doesn't feel like it, but in the context of history, mm-hmm. very, very cheap, shale boom and everything else. Now you look at what's happening today. Who wants their supply chains going through China? Like nobody right now, right? So we're onshoring our supply chains. There's no more cheap labor anywhere in the world. The demographics in China look terrible. Eastern Europe, which was a kind of cheap labor source for years, is no longer a cheap labor source. Like there's no cheap labor. And so globalization looks like that dynamic may be very different the next 10 years. And then you layer on top of that, like, I just think we've underinvested, and this is a much lengthier discussion, but I just think we've underinvested in kind of traditional energy sources like oil and gas. And we're going to go through this period where we've been used to this incredibly cheap energy source, incredibly abundant. And it's not clear to me that's going to be the next 10 years. And so if that's your view, and which is mine, then I think we probably settle back towards an inflation level that's more like 3 or 4% than 1 or 2%. And you might look at that and you go, well, that's not a big deal. Okay, that's fine. 1 or 2, you go up to 3 or 4. But what that means for bond yields is now, you're settling at a 5-year bond yield. It's probably going to be 2, 3, 4%, which means that mortgage rates are going to be structurally kind of like 3, 4, 5%. And even in a recession, the Bank of Canada might cut back to 2.5 on the overnight, but they're not going to 0. And inflation maybe doesn't get back down to 0, 1% like we've been used to. And in that environment, I just think that's fundamentally different in terms of how you value income producing assets. Mm-hmm. Like who's paying a 3% cap rate for multifamily or some absurdly low level if bond yields are going to average 4 or 5% over the next decade? And that's what I worry about.
We're on board with you. So here's a puzzle then. If I just go big picture again with you, if debt to GDP is 4 to 1, roughly, I'm rounding global debt to global GDP 4 to 1. And let's say, again, I'm making a major assumptions here, but let's say bond yields are 4%. If debt to GDP is 4%, it means the debt's growing just on the interest at 4% a year. And if the GDP, if the ratio is 4 to 1, the GDP must grow, inflate, whatever you want to call it, at something like 12%. Just to keep the spread between them roughly the same. So if debt to GDP is 4 to 1 and the numerator grows at 4% because bond yields are 4%, so the interest on the debt's 4%, is growing at 4%, GDP has to grow at a faster rate than that. Otherwise, what you get is this debt spiral move where the debt grows faster than the economy. And that's my biggest worry, to be frank. I'm like, how is this going? Because I'm with you. I see where we could be in a highly, more inflationary environment. Bonds are going to make mortgages and things like this cost 4%, 5%, whatever they are. But that also has ramifications just at the broader picture of the cost of money and the debt growing at a faster rate than the economy because we have this 4-to-1 ratio of debt to GDP. Am I being clear? Am I being clear enough?
Yeah, no, I get what you're saying. I mean, if you boil it down, you basically, the short answer is you need financial repression. You need to hold rates lower, artificially low, let the economy run hot in nominal terms.
Yes.
And over time, you sort of inflate away the value of the debt. I don't disagree with that. The question, and what I'm struggling with is like, okay, the first couple countries that try to pull that off, fine, they can do that. But you can only screw your bondholders once. Okay. Mm-hmm. Who's buying the government bonds after they do that?
Yeah.
Right. And the problem becomes once you see the first couple countries doing it, all global bondholders are going to be like, I see what's going on. And no damn way I'm going to be the bag holder. Let's dump them now. Right. And so that's what I worry about. So you're right. Maybe you could argue then that the central bank has to step in and you have just monster QE and they're just, yield curve control and just unlimited. Yeah, I don't know what that world looks like. Like, I really feel like and then you're into, okay, well, what does that mean for the currency? And okay, so if Canada's going to do that, and if they're going to try to peg the yield curve and try to keep rates low, especially relative to the US, like, well, that decimates the currency. Now you've got an inflation problem on everything that we import. Like,
just stop, Ben. You're already scaring me. Yeah.
No, but like, there's no easy way out, is what I'm saying. And so, to pick your poison, right? And I don't know what that's going to look like, but there's probably going to be some combination of like, I think you're probably going to have to try to do what you're describing, which is kind of pin.
And that's why I'm wondering if it's a volatile next 10 years where it's like, okay, we're doing this. And it's like, oops, okay, you know what? We can't come out and say it, but we need to get a little bit of liquidity into the market. We're going to keep rates where they are because we have to look like we're, conservative. So we'll change amortizations. And that's a way to get some liquidity maybe flowing without, and you can keep the narrative like, hey, we're doing our job. We're keeping rates high. But like underneath the covers, you're basically making money cheaper by changing the amortizations. And I know I'm specifically talking about the real estate market. So I'm just wondering if there's this weird cycle in the next 10 years where it's like, talk a tough game, keep everything really tight. And then kind of like, okay, we're going to push some money into the market in weird and wonderful ways. And then maybe pull that back a little bit. And we're just kind of like in this up and down. No, and I know you don't have the crystal ball, but I kind of respect your insights on it. So I was just curious.
No, look, I think that kind of volatility framework makes a lot of sense. I don't disagree. And I actually think what you're talking about with regards to kind of like loosening policy around amortization length, like I think that's definitely going to happen. I mean, think about it. Like, you've got all these trigger rates. So just think of what this means if rates just hold here, right? Even if they're not even at 5% mortgage rates, let's say they drop back to 4%, right? I mean, I've done the work on this. You roll that forward, you look at what mortgage renewals are going to look like in 2024, 2025 on kind of your 5-year terms. And even at a 4% mortgage rate, you're going to have a lot of people renewing at $1,000 a month payment shocks if you had borrowed $600,000-$700,000. And a lot of that is this dynamic of these trigger rates where it's like, we're going to hold the payment constant on your variable rate mortgage and we'll sort of let you like extend your amortization during the term. But the way that the mortgages are set up is after your initial term, you have to reset back to your original amortization schedule. So originally you had a 30-year amortization schedule, but because rates went up and they were holding the payments constant, your amortization actually extended out to like 50 or 60 years for the first 5 years, right? So or in some cases negative. They let you not even pay off just the interest component, and they tack that onto the outstanding mortgage balance. So at renewal, like originally you had a $600,000 mortgage. Now at renewal, you got like $630,000 mortgage. And it's no longer an infinite amortization. Now you have to go back to amortizing over 25 years. Those are the laws. And so an easy solution is we'll just let them re-extend the amortization without doing a full re-underwrite. Yeah. Right. And like, that's like, clearly they're going to do that. Otherwise they're going to blow stuff up. Right. Yeah. So, there's certain things where you're just like, what are the real constraints here? Right. And what are they going to be forced to do? And clearly they're going to be forced to help people that are facing these massive payment shocks. Yeah.
Haven't they already said they're going to do that? Or is that just looks like they're going to? I thought they had already said they're okay. So no, I was wrong then.
They're definitely reviewing. It's definitely open discussion right now for sure. It's tricky. Like, again, you're still kind of early days. Like, I know it doesn't feel like it for folks that are in the mortgage in real estate space. but there's not a ton of pain on the streets. We're going to get there, but there's not like blood everywhere, and there's like horrible issues around renewals and delinquencies and foreclosures piling up. Like, we're not there. This is still it's painful for some people, but this is like not a disaster.
Yeah, and Nick, Ben brought up such a good point that the mortgage arrears, I haven't looked at the latest data, Ben. I can't remember if you have it in your latest report, but they're still so low.
So low, yeah.
I think in the US, they hit in the great financial crisis like 9 or 10%. I think it was 9 or 10%. We're at like, Ben, I think you just mentioned like half of 1 point. We're like 0.5%
Oh,
or
not
something.
even. No, you're like 0.15.
0.15. Okay. And I think I remember looking at it a few years ago and like 0.9 under 1% was like a really kind of high rate for Canada.
Yeah, no, that's right. Normally in a really bad recession, you get up to kind of like, that range 0.9 and 1%, right?
Yeah. So there's room here for,
As much as I don't want to give, I don't really like giving the government credit for much because and a lot of things they do I disagree with, but I'll give them credit for this.
Oh, Nick, you're being very polite here. You're being polite with Ben here. You're being polite.
The stress test, to be fair, the stress test up till now will have alleviated. I mean, look, there's a lot of people that did fraudulent things to get around it. And, we all know there's, this crazy things that happen in the mortgage market, but overall, that stress test will alleviate some of the pain that could have come down the pipe had people not been qualifying at higher rates, because they were able to absorb, maybe not this extreme, but they were able to absorb some of it, which is that aspect of it is actually kind of good.
Yeah, no, for sure. That's the one thing where, the mortgage industry, in as much as they push back hard against it, I think today are like, holy cow, that was in retrospect a good idea. The question, and I think it's a very valid one, is like, okay, now you're back to a point where mortgage rates are, call it normal, right? Like over the last 30 years, it's 4 or 5% rates are pretty kind of standard. So like, what's the big concern here? Like the stress test made a ton of sense when you're dealing with like 1% mortgage rates that were way below the rate of inflation. Yeah. You're like, well, this can't stay here, right? So the regulators were very wise to their credit, saying, look, let's make sure people can afford it. Is it still necessary to have a, plus 2% stress test on a 5% mortgage rate, or even worse on like an Alt-A mortgage where you're at like 7.5%. Now you're stress testing at like 9.5%. Like that's, you start to go, okay, what's reasonable now that we're back to long-term norms, or even maybe slightly above kind of normal levels for rates? It's a fair question.
Yeah. What I was wondering is, do you think that, man, I completely lost my train of thought as you were saying that, because I started.
Let me ask. So, Nick, while you gather that one up, let me ask Ben. Ben, what are you seeing on money movement? Because I know you do a good job tracking mortgages, money. Are you seeing any weird money movement coming into Canada, or any sort of new or shocking mortgage fraud stuff going on currently in Canada? I don't think anything could shock you actually at this point, because you've tracked this so long. But are you seeing any changes in the whole mortgage game and some of the funny business over the years that's gone in with capital coming into the country, or mortgage qualification from people within the country? Anything new in that area, or more standard stuff?
No, I think if anything, it's the tide's kind of going out. So, who's rushing to falsify income documents to jump into a market that's falling, right? Nobody's trying to catch that knife. Right? You see that stuff when the markets are going crazy. So look, I don't really think that's a huge issue right now. On kind of like the international capital flight, it is interesting. Like you just had out in BC, and I think this is symptomatic or indicative of kind of the mentality of Canadians, that we're starting to kind of get sick of some of the shit that we're learning about, money laundering. And we're to the point where you get the sense that people are ready to take it seriously. And so I'll use BC as an example. They just, November 30th was the last day where you were supposed to file beneficial ownership registry documents. So, if you're a or if you own property in any capacity, whether it's your holding company or whatever, you have to disclose who the beneficial ownership of. You cannot hide behind a numbered company. And so that's very interesting. So now you're going to have a searchable registry where people from other countries, governments from other countries can figure out whether some of their corrupt officials have taken money and planted it in Canada. And if they have, they maybe have recourse to get it back, right? That's very interesting. The other thing that we learned just last week is BC is rolling out an unexplained wealth order. And the idea there, I don't know if you've heard of these, they've kind of had mixed success in other jurisdictions, but the idea is this. Tom, you are living in a $8 million house, but yet you are claiming on your tax return that you make $10,000. Explain yourself, right? And this is very powerful. And what it does is it flips the onus onto you to prove that you did not buy that through illicit gains, right? So that you're not laundering money, right? And so, if nothing else, it's at least a signal.
Yeah, that's a good one.
They launder money. Well, yeah, like that's a real problem in BC. We know it's a problem out there, and they need some tools to be able to say, like, look, this doesn't make sense. You cannot claim that you're a housewife living in a $20 million house, right? Something is not computing there, and so. You can debate how effective it's going to be in the long term, and it's had mixed results in other jurisdictions where they've tried this. But the messaging is important, and the messaging would seem to be that, look, we're kind of tired of this shit here in Canada, and it feels like there's the political will to start going after some of this stuff, and I think that's a really good thing.
I agree. So then in Canada, are you seeing anywhere at any government level changes in discussion on housing supply? Are you coming across any positive movements, any hints of anything that, I know in Ontario, there's some stuff that might be changing.
Yeah.
What are you seeing on that front? Okay.
Yeah. So I think in line with this whole kind of money laundering, shady stuff, I also think you're starting to see some acceptance on the part of policymakers that we need to have more aggressive means to sort of incentivize new supply. And typically, I think it's taken the right form, right? Like if we think about where's the pinch point in bringing new supply, and I know it doesn't feel like we're in an undersupplied market right now. If you ask it, prices falling, it's like, well, how are we undersupplied?
Sure.
But, you roll this forward 5 or 10 years with this sort of population growth, you're going to have a really serious problem.
We're screwed.
Yeah. And so the pinch point remains at the municipal level, where you've got municipally elected councillors that have to listen to the next door neighbor bitch about, well, why is that condo development going in behind us? And it's, it's ruining the vibes of the neighborhood. And it's like all this other shit. And it's like, they want to get into a neighborhood and they want to shut the door behind them from anyone else moving in. And that's just, And so, what we're seeing now is a recognition from the province, at least in Ontario, that like, look, we need to either incentivize municipalities to get behind redevelopment by tying funding to their ability to, permit more housing, or frankly, to remove their authority to say yes or no, right? And so you're starting to see some recognition that that's a real problem and that needs to be addressed with more aggressive means. And like, I think, and then, you can also debate the whole green belt, releasing some land. They didn't technically release, they sort of released some area and then sort of shifted it over here. So they on net, but you can debate whether that was the right move or the wrong move, but it's a recognition that we need more supply and there's pinch points in the process and we need to work around those pinch points. And so whether it's the right move or wrong move is up for debate, but it's certainly indicative that governments are moving in that direction.
Ben, if we put you in charge of housing in Canada, what are some of the moves? Yeah. What are some of the moves, either interest rates or supply, like from whatever angle you want to take it? We're putting you in charge of the Bank of Canada, or you're the new finance minister, or you're in charge of housing. You pick your role. But I'm sure when you're looking at the data, you seem, very well informed and opinionated. So what are you going to do? What are some of the things that you're like, I can't understand why we're not doing this right now?
Yeah, I think there's low-hanging fruit
that
we absolutely need to be dealing with. So I don't think there's a silver bullet, but there's simple things that can start to move the needle when you add them together, right? And so from like a kind of really basic perspective, it's like we still have demand in this country that is just unhealthy, right? Like you still have some element of international speculation. You still have some element of money laundering. Like, for God's sake, start tightening up rules around money laundering. Like, that's just really simple. And go after them and give law enforcement the teeth to go after money laundering and illicit capital.
Yeah, it's an obvious one. You're right.
It's an obvious one. And so roll out a beneficial ownership registry nationally, right? Find the shit out of people who aren't following the rules, right? If you got a vacant home that's just being parked because you're some oligarch, you just want to like have a safety deposit box in it, fuck that. Tax the shit out of that. Right. So whether that comes in the form of like raising property taxes, and having it deducted against local income. Like that's a solution. So raise your property taxes, deducting it against local income. So if you're making local income, you can deduct part of the increase, right? But if you're not, now it becomes more punitive to hold a vacant property, right? So I mean, you know, solutions like that. It's not a silver bullet, but it helps move the needle. I think trying to incentivize new supply is clearly going to be important, and so some of the policy directives we've seen around removing the ability of municipalities to just removing nuisance lawsuits as an example. Okay, so what some of these community groups love to do is a developer wants to come in and they want to bring new supply, and these local groups, they're just going to do nuisance lawsuits to just screw them and hold them up in courts and cost them. And one of the things that would be interesting is if they could bring in some legislation that would say that's fine if you want to bring these lawsuits, but you need skin in the game. So it's going to be a $10,000 bond. And if you lose, that goes to the developer to cover their legal costs, right? And so like just making it
another good one,
for people to just screw things. And then the other thing that I think is important is like, look, I'm in favor of strong population growth. We need immigration. The population dynamics in Canada are such that like we're just not producing enough babies here organically. We need to bring people here. That said, we've got targets around permanent residence. Okay, so what we typically think of immigration, and you can see the targets going up over time. That's great. I'm in favor of that. What I don't like is that we have seemingly no sound policy around non-permanent residents. Okay, and so as an example, international students is a big one. Last quarter, just one quarter alone, we had an increase of 160,000 non-permanent residents. It's the biggest we've ever seen. Now, where are we going to put 160,000 non-permanent residents who are all going to be looking for rental supply? That is not counted in that 500,000 target for immigration. That's a completely separate bucket. And so like, why don't we have targets around foreign students, international students? Like, why aren't we forcing the university and colleges to step up and say, if we want new students, we have to step up and get the funding and build the rental supply that we're going to need for those students, right? Like, it's just like, you just can't, just common sense stuff. If you're going to benefit from it.
Listen to this. One of the property managers we know outside of Western University has a waiting list of 65 groups of students for properties right now. Another one still at Western, has 40. That's groups of students that could be 5 or 6. That's just what they are aware of as the waiting list. One student rental that we're very familiar with is they renovated. It's beautiful. It is a 5-star.
It's an anomaly. It's an anomaly.
It's individual bathrooms, like just beautiful house. They're trying to get, and they know they're going for a high amount. They're trying to get, because they had to spend money on the renovation. And now rates have gone up, which they didn't account for. They're trying to get per room $1,200 per student rental room. Can you believe that? And that they haven't got it yet. So I don't want to say that was even achievable, but just the fact that someone is thinking that they can go for that amount.
It's crazy. And like the universities and colleges have become extremely reliant on international students admissions as a source of funding because they pay so much more than Canadian students. Fine. You want to do that? That's fine. But you got to figure out where you're going to put them, right? Like you can't dump 200,000 international students in Kitchener-Waterloo and expect that we're going to not have a rental issue. Right. So and again, that's not addressed in any of the policies from the feds. They're just kind of like, doors are wide open. Just, hey, you want to come. It's like, well,
and here's
the problem about this.
The problem with that as well is I don't think there's any planning with the government. So basically the universities, or call it, now it's not even universities, because now there's all these kind of small schools or colleges or kind of, not even the big colleges people are used to, that are popping up. And the business plan is to bring in international students to try to give them a path to citizenship. Like this is openly being talked about. There's recruiters in other countries. So like this is a whole new business now. So now we have these, not even just the main universities, but we have this other industry that's popped up that is dictating our immigration numbers and our immigration policies based on the non-permanent residents. And there's no communication to what their targets are, there's no planning saying, hey, here's the next 2, 3, 5-year plans for our international student enrollment so people can plan. The governments aren't talking to them at all. So basically we have the government immigration policy. And then we have this post-secondary student immigration policy that's completely independent of that.
Yep. No, totally. You're totally right. And I think what we're going to find in coming years is that has been massively abused, that what we consider an eligible post-secondary institution, I'm going to use that term very loosely, you're going to get these things popping up everywhere that effectively all they're going to be doing is they're going to be mills to turn out international students, give them quote unquote accreditation, but really it's just a cheap way to get a foot in the door. And we're just going to sell citizenship to basically allow people to profit off of this sort of private entity that's selling citizenship.
We got a guy in our office we asked him to pull the different enrollment numbers from some of the colleges in the Niagara region. And we let's see where the growth is and what programs the growth is in. And there's some new programs that came out, and the programs where the growth is in is like, I forget, but it was like hairdressing and aesthetics and stuff. The growth is dramatic in a lot of things that just, that have been very steady for a prolonged period of time. Or there's these new schools coming up, and the growth is just huge. And these types of programs that you wouldn't expect to this kind of high level growth in, you know what I mean? Like we're seeing it. I wish I had the exact numbers here, and we're looking at this. We're like, oh my God, these are basically immigration mills. Like this is all it is. And a guy that works with us in our office, he immigrated from India, I guess what, Tom, 3-4 years ago now?
Yeah, maybe 4 years now.
Yeah. And he tells us how it is there, how they're trying to approach getting people into Canada, and how the recruiting systems work.
How they put up the pictures of the Rocky Mountains. They put up the pictures of the Rocky Mountains with the Canadian flag and are big. And it's very prestigious to come to Canada and to come to Toronto.
But the thing is, like, you can see it's being abused now already. I'm not anti-immigration. I like you said, we need immigration. I wish they were a little bit more, there's more communication around it, and they thought about maybe infrastructure, like things like roads and hospitals in areas where there's a lot of immigrants going, and like
which is what we've just talked about, housing, but the pressure on our hospital system.
Oh gosh.
Yeah. Right. But it's there's just no conversation around it. Like, so I'm pro immigration, but they just got it. Like, it's obvious already. The way the system structured is being abused. Like you said, with some of these things, why do we have to do everything like wait 10 years and then look back and be like, oh, we made a mistake, when if you're on the streets listening to people, you can see that there's things going on already. It's just a slow moving process.
It's funny. Somebody posted on Twitter, I think they were bang on. They basically said like, if you were trying to figure out a way for the government to like alienate Canadians and make them, and sort of like stoke anti-immigration sentiment, it's almost indistinguishable from current policies, right? Because if you were trying to enrage people and trying to make it look like you didn't have a sensible plan and get people pissed off about immigration, it looks very much like what we see right now, which is kind of like, we're not really thinking about these bigger societal issues around like housing. We're going to put people in, fine, $500,000 immigration target. Fine. What about the 200,000 non-permanent residents you're letting in? What are we doing with them? Right. And how is that not lumped into the same bucket? Right. Totally agree with you guys on all that.
What about, I'm just curious here, single family. This is something that always gets with single family supply. And I know it now changes to the green belt, and because they've opened up other areas, you'd think there's going to be more low density developments in those areas versus like we're just getting housing units from condos and kind of higher density stuff. Here's my thing. So with where prices have gone of not real estate, but of land, which is the real estate component, but labor, where that's gone with materials and that type of stuff, I think a big reason that there's been less single family development is that the cost to do it and then to sell it is higher than a lot of people can afford. So there's just not the same absorption as there is in the lower cost units, which are higher density. Unless those things change, I don't see a huge rebound in single family coming unless I'm missing something. What am I missing?
Rebound in construction or rebound in demand? In
construction, sorry. In new construction units for low density housing. And I guess particularly I'm looking at the kind of, the Ontario area,
but you're talking traditional detached backyard, all that.
I mean, even if today's backyard, which is, only 10 feet deep or whatever, but that type of thing. Yeah.
I think policymakers would probably be fine with that. Like, I think that the focus from policymakers is on increasing density to some extent. Right. And so, away from as much as we can, away from the traditional detached, big footprints, big yard, and into something that's more, just higher density.
Yeah.
I think you're probably right. I think that's probably an era of the past until we sort of figure out how to move zoning forward and do it more thoughtfully. But even at that, like, again, it gets back to this population numbers. Like, if you're going to add 500,000 people a year to the population, how are you going to have single family in all the desirable areas? So longer term, like, it's not hard to paint a bullish picture for single family once you're through the next kind of, next year or two where we have all this rates uncertainty.
Ben, before we let you go, I think you brought up Bitcoin, not me. So now I'm curious. I have a feeling you're about to smash me with something about Bitcoin. I'm not sure what's about to come out of your mouth around Bitcoin, but what are you?
I'll give you my.
I'm scared to ask about Ben's views on Bitcoin.
I'm not. Okay, here's what I'll tell you. I've been I've invested in Bitcoin in the past. I've actually traded it really well. Like, I got a lot of things wrong, but I've traded Bitcoin really well, and I was out at pretty close, like within I don't know, 5,000 from the peak. I was out completely. And so, okay, well, why was that? And let me be very clear that I make a strong distinction between Bitcoin and virtually everything else in the crypto space, because I think by and large, the only real value of most of these altcoins is to separate investors from their money, right? And that's like,
we're already good friends, Ben. We're already this is headed in the right direction. You keep going.
But Bitcoin is different. I do think Bitcoin is different. There's look, I'm gone way down the rabbit hole on this. I have no issues with Bitcoin. However,
I knew this was. I thought he was going to say, but however, yes.
Look, whether you like it or not, it's still a speculative asset. It's a long duration asset, and in a rising interest rates environment,
sure,
it's going to get hammered. And so, it's not a shock that it's kind of fallen the extent that it has. What's very interesting, and what I think has my attention now, is you basically detonated the crypto market, and Bitcoin is holding firm at like 16, 17, and it's not really moving. And when you have like a neutron bomb go off in a sector and everything falls but one thing, you should be looking at that going, oh, that's interesting. What am I missing here? And so Bitcoin has a lot of like relative strength right now, where I would have thought it would have gotten absolutely obliterated. I find it interesting at these levels. What's keeping me from pulling the trigger is Tether is almost certainly a fraud. Like, I haven't been down that rabbit hole. Okay, well, you need to, if you own Bitcoin, you need to go down the Tether rabbit hole, because, in as much as you might think that there's a hard cap on the supply of Bitcoins, there's absolutely not a hard cap on the money flowing into the space through Tether. And what that might be doing for boosting incremental demand. And it's almost certainly a fraud. I mean, I don't say that lightly. It's certainly a fraud. And so if Tether, and I don't know what that means, right? So you could come out tomorrow and say Tether has the dollar backing on Tether is not there. They don't have, they certainly don't have the reserves that they stated that they had. It was all made up. They created fake capital flows into Bitcoin. Okay, fine. I don't really know what that means. Maybe it means Bitcoin drops another 50%. I have no idea. But until I get some clarity around Tether, it's clear to me that Tether has been a massive source of incremental flows in incremental demand to Bitcoin. And until I get some clarity around what that all means to the ecosystem, I'm kind of out. And the other thing I think is just like, when you look at Bitcoin from a longer term perspective, like, it's not hard to see the cycles. If you plot the price of Bitcoin on a log chart, it's really clear that, you can basically wait to the halving, roll it forward another year, and you get another speculative boom. And then, that ramps up, and then it kind of falls, like what we're seeing. You get this kind of crypto winter, quote unquote, for a couple of years. And then it rolls close to the next halving cycle, and the whole process repeats. And so, like, we're kind of in that, what's traditionally been that crypto winter, where you wait for the next halving, and then, you buy it all up kind of like 6 months after the halving, and you wait for the cycle to repeat. And so I don't think there's any rush. Like, the only thing that would change my mind on that is if you came out where the regulators in the US said, okay, fine, we're going to allow ETFs. And all of a sudden now you can let the institutional investors get significant exposure. Well, that would certainly increase the demand profile. But barring something like that, I just think there's too much clarity. I don't see what the impetus is for another big leg up in Bitcoin until you get closer to the next halving cycle. So it's like, well, It just feels like it's probably going to be dead money. And then you got this tether issue overhanging. And I just don't really know what that all means for this ecosystem. But when you have like a massive player in the space, it's clearly a fraud. Like I don't need to be there. So I'm just going to wait on it. But I don't hate Bitcoin by any means. I'm not one of those people that's like, oh, it's a fraud, there's no value to it. No, it's absolutely, it's a brilliant piece of engineering, and I think it's designed to endure. It's not. I don't believe it's hackable. I don't believe it's fake. I'm just not there right now. I just don't have strong conviction on it.
Interesting. Yeah, I love this. Now we get to talk to Ben about real estate and Bitcoin. Get his views on both. This is amazing. Yeah. Thanks for sharing that, Ben. Kind of, I didn't know what you were going to share, so I didn't realize that you were
not a hater. I'm not a hater. I fully intend to own it again. I just, it's like anything else. There's a time and place.
It's a really valid. It's a valid argument for sure.
Yeah. And so Ben, before we let you go, how would you wrap up the real estate market, or anyone thinking about the real estate? Has too many angles. That's not even a fair question for you. It's just like too much going on. But I guess just what would you say you're looking for going forward? Would it be the spring market inflection point, which way things are going to break?
Yeah, I really think kind of the big things you'd be watching right now is like inventory trends going into the spring. Mm-hmm. That's like a really big one for kind of like the direction of the next leg. And I do think there's reason to be optimistic around the demand side. If you get a bit of rate stability, I do think there's a lot of people sitting on the sidelines. That'll come back. But yeah, supply is the big one. And then kind of it's harder to track, but just sort of keeping tabs on like where the pinch points are. And so that kind of private non-prime credit space, like I think we're probably in the early stages of some forced selling out of that space. And then as you guys noted, the pre-construction space, I think we're probably like inning one, or maybe even still in the warm up of like just some pain coming from a lot of those investors.
Ben, always appreciate your time. We've kept you a few minutes too long here, so I want to wrap up with you. If anyone's going to find you, anyone listening to this has to follow Ben on Twitter. So if you're at all on Twitter, you just share such incredible information. I think one of your tweets that really caught my attention were the population growth in Canada versus the US. I think you put that out maybe a week ago or a couple of weeks ago. Just such great information. So we will link to your Twitter handle, but if you could just share your Twitter handle now. Sure. And then I know you do a bunch of different things. So if you could just lay out where people can find you and some of the things that you offer. Could you please share that?
Sure. Yeah. So Twitter is at Ben Rabidoux. So you guys can link to that in the show notes or whatever. But for those who are involved in the real estate space in some capacity, I do have a research offering. So, do kind of research notes every other week. We do quarterly update calls, create infographics for marketing. So if you're in that kind of, real estate sales or mortgage space, development, some interesting tools available for you there. So that's edgeanalytics.ca. You can check out, you can sign up, see for a month for free. If it's not your cup of tea, pretty easy to fire. That's. And
I just want to share on that. We are subscribers to that, and it's amazing information. 100%. So I think we've been subscribers from pretty much day one. And
you guys were one of the first. I think you were like within the first like 5 people to subscribe for sure. So I appreciate your support.
Well, we were trying to get some of this information ourselves, and then you come along and you're like, hey, I'll just assemble what I've been doing in this beautiful format here. So we are huge fans of it. Gives you a lot of clarity into what's going on. So we are absolute fans. And we want you selfishly to just keep putting that information out because we just love it so much.
Well,
so
thanks,
thank you.
Appreciate it.
Yeah. Thank you for that. So, and then anything else you wanted to share?
No, I think that's it. I think it's it's going to be an interesting time for I know you get a lot of investors in the space, and I think there's going to be some interesting times coming up. Probably some good opportunities. So just keep your eye open, and just don't get swept away by the fear side and the fear mongering in the media, but also just don't drink the Kool-Aid. Don't drink the 25% guaranteed nonsense, right? Just be
up to 25%, Ben. Right. Up to 25%, but no more. It's not 26.
That's right.
Ben, thank you so much for this. Really, really appreciate it. Thank you.
Thanks, guys. Good to chat.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Terms show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.